The federal government spent the 1930s passing more laws about money than in any prior decade of American history. Some Americans obeyed. Many did not, and they were clever, creative, and thoroughly motivated. If Depression-era history and the ingenuity of ordinary Americans under pressure interest you, consider subscribing so you never miss a video like this one. Number 25. Hoarding gold coins after Executive Order 6102. On April 5, 1933, the most dramatic financial law in American history took effect overnight. President Roosevelt signed Executive Order 6102, making it a federal crime for any American citizen to own more than $100 in gold coins, gold bullion, or gold certificates. The penalty was staggering, up to 10 years in prison and a $10,000 fine. Millions of Americans refused to comply. They buried coins in their yards, pressed them into the soil beneath garden beds, sealed them inside walls, and tucked them deep into furniture. The Treasury Department's enforcement effort was real, but limited agents could not search every home in America. Estimates suggest hundreds of millions of dollars in gold coins never made it to the Federal Reserve, and some of those coins are still being found today. Number 24. Operating unlicensed kitchen banks. In the immigrant neighborhoods of Chicago, New York, and Detroit, trust did not live in buildings with marble columns. It lived in certain kitchens, run by certain people, usually a neighborhood elder or a respected community figure, who took deposits, made small loans, and kept the books in a ledger on a shelf above the stove. Over 9,000 banks failed between 1930 and 1933. For communities that lost all access to formal banking, unlicensed kitchen banks were not a scheme. They were a lifeline. They were also a direct violation of federal and state banking laws, which required licensing, capital requirements, and regulatory oversight that no kitchen operation could meet. The Federal Deposit Insurance Corporation, established in 1933, was created partly in response to the chaos these failures and informal alternatives had caused. Number 23. Burying cash and coins in the yard. Federal Reserve estimates from the period suggested that more than $1 billion left the American banking system and entered household hiding places in a 2-week period in February of 1933. Not all of it went into walls and furniture. A significant portion went into the ground. Burying cash was not itself illegal. Burying cash to avoid reporting taxable assets to the IRS was a different matter entirely, and that was exactly what many Americans were doing. The IRS knew it. Its investigators had a term for it: wealth going dark. Tens of millions of dollars in taxable assets simply vanished from government visibility into holes in American backyards. Number 22. Hiding currency inside walls during construction. Stuff it in while the wall is open. That was the logic. Elegant, practical, requiring no special tools or knowledge. A carpenter working on a renovation job slips a roll of bills behind the lath before the plaster goes on. A homeowner frames up a new partition and seals savings inside before hanging the drywall. Decades later, during demolitions and renovations all across the country, workers found the evidence. Published news reports have documented multiple discoveries of Depression-era cash inside wall cavities, sealed beneath floorboards, and tucked inside ceiling joists in Ohio, in Cleveland, in Minnesota, and in communities across the Midwest. In several cases, the amounts discovered ran into the tens of thousands of dollars. The money had outlasted the people who put it there. Number 21. Conducting barter to avoid cash income reporting. The IRS position on barter was clear by the 1920s. If you exchanged labor or goods for other labor or goods, you were required to report the fair market value of the exchange as taxable income. The American farming community's position on this rule was equally clear. They ignored it almost universally. Neighbor helped neighbor with harvest. A carpenter fixed a roof in exchange for a winter's worth of firewood. A doctor accepted eggs, preserved food, and homemade goods as payment from patients who had no cash. Every one of those exchanges was technically taxable income. Almost none of it was ever reported. The IRS enforcement capacity in rural America during the 1930s was insufficient to address the scale of the problem, and most agents knew it. Number 20. Operating illegal distilleries to generate hidden cash. The Volstead Act fell in December of 1933, but the moonshining economy that had built itself around prohibition did not simply stop. The federal excise tax on legally produced liquor was substantial, and for Appalachian families, rural Southerners, and cash-poor farmers across the country, the calculation was straightforward. Untaxed liquor meant untaxed income. Federal enforcement reports estimated hundreds of millions of dollars in spirits revenue moved through unlicensed distilleries annually during the Depression decade. None of it was reported to the IRS. All of it was technically criminal, and a significant portion of it represented the only reliable cash income certain communities had access to throughout the 1930s. Federal agents raided stills, families rebuilt them. Number 19. Stashing money inside furniture, mattresses, sofas, chair cushions. The phrase mattress money did not start as a metaphor. Between 1929 and 1933, as bank after bank closed its doors with no warning and no recourse for depositors, ordinary Americans reached a simple conclusion. The safest place for savings was somewhere the banks could not reach. Federal Reserve surveys from the early 1930s documented the withdrawal of hundreds of millions of dollars from the banking system into physical household locations. Mattresses were stuffed. Chair cushion seams were opened and restitched. Sofa frames became informal vaults. IRS agents tasked with investigating unreported income had no authority to search private homes without cause, and cause was nearly impossible to establish when a family's savings existed entirely as anonymous paper currency, sewn inside a piece of furniture. We are halfway through this list, and the ingenuity of Depression-era Americans has barely begun to surface. Drop a comment and let us know where you are watching from and whether any of these practices sound familiar from stories in your own family. Number 18. Using family members' names to conceal asset ownership. The Revenue Act of 1932 raised the top marginal income tax rate to 63%, a number that focused the minds of anyone with significant assets. The response in many households was to redistribute those assets on paper. Property changed hands. Bank accounts were re-registered. Businesses were transferred. The recipients were almost always family members, spouses, adult children, parents who would face lower tax assessments or none at all. When the transfers were genuine gifts with real transfer of control, they occupied legal gray territory. When income continued to flow to the original owner while the assets sat in someone else's name, they constituted tax fraud. The IRS prosecuted cases on exactly this basis throughout the 1930s, though its conviction rate was limited by the difficulty of proving intent. Number 17. Running cash-only businesses off the books. Down every commercial block in Depression-era America, at least one or two operations ran entirely on undeclared cash. The laundry that kept no books, the repair shop that wrote nothing down, the food stand that took in $20 a day and reported nothing to anyone. These were not sophisticated schemes. They required no lawyers, no accountants, no shell companies. All they required was a commitment to keeping transactions entirely verbal and entirely unrecorded. The IRS knew the underground cash economy was enormous. It lacked the personnel to investigate the tens of thousands of small businesses that operated this way. Individual auditors were assigned territories covering hundreds of businesses and simply could not reach them all. The cash went where the government could not follow. Number 16. Hiding gold in everyday household objects. False bottoms, hollowed-out books, clock casings, flour canisters sealed with a secondary lid. Every object in a Depression-era home was a potential vault. Executive Order 6102 required compliance. It did not guarantee discovery. Americans who chose to keep their gold found that concealment within ordinary household objects was almost perfectly effective against any enforcement effort short of a full property search, and full property searches required judicial authorization that most agents could not easily obtain. Antique dealers and estate sale operators throughout the 20th century regularly discovered gold coins inside objects that had been sealed since the 1930s. The hiding had worked exactly as intended, so well, in some cases, that the people who hid it died before they could retrieve it. Number 15. Paying wages in goods instead of money to avoid payroll records. Across the farms of the Great Plains and the small workshops of the industrial Midwest, a quiet renegotiation of the employer-employee relationship was underway. Cash was scarce. Government oversight was expanding. The solution was older than money itself. Workers accepted food, clothing, seed, and household goods in place of wages. Employers preferred it. No payroll records meant no documentation of taxable compensation, and no documentation meant nothing for IRS investigators to audit. Both parties benefited from the invisibility of the arrangement. Department of Labor investigators documented the practice extensively in the mid-1930s, particularly in agricultural labor, but enforcement was slow and penalties were inconsistently applied across states. Number 14. Using scrip and local currency to keep transactions off federal records. Between 1931 and 1934, nearly 300 American communities issued their own locally printed currency scrip to keep commerce moving when federal dollars had effectively stopped circulating in their economies. Some scrip systems were authorized by state governments. Many were not. The key advantage of scrip for Depression-era Americans was its invisibility to federal tax authorities. Transactions conducted entirely in local scrip generated no federal paper trail. Income earned in scrip was taxable under federal law, but practically impossible for IRS agents to detect or quantify. The clearinghouse certificates issued in several major cities and the countless homegrown community scrip systems represent one of the largest informal tax evasion mechanisms of the Depression, though participants would likely have described it simply as survival. Number 13. Concealing savings in religious institutions. In the years when banks could not be trusted, churches could. That was the reasoning in hundreds of communities across America, particularly in immigrant neighborhoods, rural Southern communities, and tight-knit ethnic enclaves where the local priest, minister, or rabbi held the same authority as any banker. Families deposited savings with their religious institutions, receiving informal receipts and the assurance of the community's moral weight as security. These arrangements operated entirely outside federal banking regulation and outside IRS visibility. In cases where depositors were also concealing those assets from tax authorities, the arrangement constituted tax evasion. In most cases, it was never investigated, never prosecuted, and never recovered by any government agency. Number 12. Falsifying business expenses to reduce taxable income. The Revenue Act of 1932 did not merely raise tax rates. It compressed what had been a modest federal income tax burden into something that felt, to the business owners who faced it, like confiscation. The top rate went from 25% to 63% in a single piece of legislation. The response was creative accounting on a national scale. Business owners inflated expenses, created fictitious vendor payments, attributed personal costs to business operations, and generated elaborate paper trails that obscured true net income. IRS annual reports to Congress throughout the 1930s repeatedly flagged the scale of fraudulent business deductions as the agency's primary enforcement challenge. The problem was not new. The 1930s made it pervasive. Number 11. Moving assets into trusts to shield them from taxation. In the law offices of New York, Chicago, and San Francisco, a different kind of Depression-era adaptation was underway. No mattresses, no buried coins, no lawyers or shell companies, just lawyers. The trust structure had existed in American law for generations, but the aggressive tax environment of the New Deal transformed it into a primary vehicle for wealth preservation. Family trusts, charitable trusts, and elaborate multi-tier legal arrangements proliferated throughout the 1930s as wealthy Americans raced to place income and assets beyond the reach of the federal tax system. Congress noticed. The Revenue Act of 1934 and the Revenue Act of 1937 were written in significant part as direct legislative responses to these strategies, evidence that the government and its wealthiest citizens were engaged in an ongoing and explicit contest over who would control what. Number 10. hiding savings in false bottom containers and secret compartments. Carpenters who built furniture during the Depression sometimes built two pieces, the one the customer could see and the one the government could not. False bottom trunks, double-walled cabinets, and concealed floor panels became genuine products of the period, made and sold in the knowledge that their buyer's primary interest was security, not decoration. The Federal Writers Project, a New Deal employment program that sent writers across America to document ordinary life, recorded numerous accounts of families who kept their savings in hidden compartments rather than in banks. Their reasoning was invariably the same. The banks had already proven they could fail. A well-built secret compartment had no closing hours and no risk of bankruptcy. Number 9. Operating unlicensed pawnshops and lending operations. By the middle of the 1930s, the licensed pawnshop network in most American cities could not absorb the demand. People needed cash. Licensed shops were overcrowded, regulated, and required to report certain transactions. The unlicensed alternative required none of that. In basements, back rooms, and private apartments, informal moneylenders operated throughout Depression-era cities. They charged interest, often steep interest on personal loans, accepted goods as collateral, and kept no records that any state banking commission could review. The income they generated was entirely unreported. Their operations violated state banking laws in every jurisdiction where they operated. They also served a genuine function in communities where formal credit had entirely collapsed, which made enforcement politically complicated and practically difficult throughout the decade. After this many entries, you can see the pattern. When the formal economy fails, the informal one expands to fill the space. Leave a comment and tell us which of these practices surprised you most. Number 8. Concealing foreign bank accounts. Across the northern border and the Atlantic, American money was quietly finding new homes. Canada was convenient. Switzerland was discreet. The United Kingdom offered stability. For wealthier Americans who had the international connections and the capital to move funds abroad, foreign bank accounts offered something domestic hiding places could not. The legitimacy of a real financial institution, combined with the near total invisibility of overseas jurisdiction. The IRS had minimal international enforcement capacity in the 1930s. Foreign banks had no obligation to report American depositors to the United States government. Income earned through foreign accounts was taxable under American law, and deliberately concealing it was illegal, but detection was almost non-existent. The reporting requirements that would eventually close this gap did not fully arrive until the Bank Secrecy Act of 1970. Number 7. Converting cash into jewelry, art, and collectibles. Portable, concealable, untraceable. Those three words described the ideal Depression-era asset, and nothing fit them better than jewelry, silverware, antiques, and art objects. After Executive Order 6102 made gold hoarding illegal and the IRS expanded its scrutiny of cash holdings, Americans with means converted paper money into objects that government assessors struggled to value and were nearly impossible to track. A diamond bracelet could be worth thousands of dollars and pass through an estate completely without government notice. A collection of silver serving pieces could represent a family's entire savings, sitting in plain sight on a dining room sideboard. The Treasury Department knew the practice was widespread. Documentation and enforcement were another matter entirely. Number 6. Using nominee owners for real property. In courthouses across America, property records from the 1930s tell a story of relentless creative reshuffling. Farms changed owners, buildings were transferred, land titles shifted to names that, in many cases, bore no real relationship to the people actually occupying and operating the property. The use of nominee owners, relatives, trusted friends, or sometimes entirely fictitious persons to hold real property allowed the true owners to live on and profit from their land while presenting government assessors with a balance sheet that dramatically understated their actual wealth. When this was done to reduce property taxes, it constituted state tax fraud. When it was done to falsify the means testing required to receive federal relief, it constituted federal fraud. The New Deal's relief programs generated an enormous caseload of exactly these frauds documented in the administrative records of the Federal Emergency Relief Administration. Number 5. Underreporting farm income and crop yields. The Agricultural Adjustment Act of 1933 was, by any measure, a remarkable piece of legislation. The federal government would pay farmers to grow less in the hope that reducing supply would drive up prices and rescue American agriculture from collapse. Farmers had to report their acreage and yields to qualify. Many did not report accurately. A farmer who declared a reduced acreage to qualify for AAA payments while quietly planting additional acres, selling the undeclared harvest through informal channels, and collecting both the government payment and the underground market income was committing fraud against a federal program. USDA enforcement agents documented the practice across the Corn Belt and the Cotton South throughout the mid-1930s. Some prosecutions followed. Most did not, because the administrative burden of verifying crop reports against actual field surveys was beyond the capacity of the agency. Number 4. Hiding assets to qualify for government relief programs. The federal relief programs of the New Deal required applicants to demonstrate genuine financial need. For the millions of Americans who had concealed savings, hidden gold, buried cash, or transferred property into relatives' names, this created an unexpected opportunity. Their declared assets were minimal. Their actual assets were something else entirely. Federal Emergency Relief Administration caseworkers were overwhelmed responsible for investigating thousands of applications with inadequate staff and no reliable means of verifying what applicants had hidden. Families that had spent years carefully concealing their financial positions from the IRS found that same concealment now qualified them for government assistance they might not otherwise have been entitled to receive. The overlap between Depression-era tax evasion and Depression-era relief fraud was, according to FERA's own internal reports, substantial. Number 3. Keeping double sets of financial records. 2 sets of books. The real ones told the truth. The official ones told the government what the business owner wanted it to know. In between, there was a gap, sometimes a modest gap, sometimes a stunning one, representing income that moved through the business in cash, was never entered into the official ledger, and was never reported to anyone with a badge and an audit authority. Double booking was not an invention of the Great Depression. It was, however, the period in which it became almost routine across American small business. IRS Criminal Division case files from the 1930s are densely populated with prosecutions built on the discovery of a second set of books found in desk drawers, inside filing cabinets behind official records, tucked under counters, or carried home each night in the owner's briefcase. When investigators found them, the cases were straightforward. Most were never found. Number 2. Using coded language and shell businesses to move money. By the mid-1930s, the most sophisticated financial minds in Depression-era America had moved well beyond buried coins and hidden compartments. They were building architecture legal structures on paper designed to route income through multiple entities in ways that made it nearly impossible for any single IRS agent to trace from origin to ultimate destination. Fictitious businesses existed on paper, received payments, and passed money forward through layers of transactions. Coded language in contracts and correspondence obscured the true nature of financial arrangements. The shell company structures that would become a defining feature of American tax avoidance for the rest of the 20th century trace their lineage directly to the Depression-era improvisations of business owners who found that paperwork, deployed creatively, was the most durable hiding place of all. Number 1. Simply not filing a tax return. The federal income tax was ratified in 1913 under the 16th Amendment, but 20 years later, in the depths of the Great Depression, large portions of the American public had not yet fully accepted it as a permanent feature of life. The Bureau of Internal Revenue estimated that millions of Americans who owed federal income taxes were simply not filing returns throughout the 1930s, either because they did not understand the requirement, because they saw no risk of discovery, or because they were exercising a quiet, private form of resistance to a government they felt had failed them. No buried coins, no secret compartments, no lawyers or shell companies, just a man or woman sitting down at a kitchen table in the winter, receiving the forms the Bureau of Internal Revenue sent and deciding not to send them back. In an era when the formal economy had collapsed and the government seemed to offer more hardship than help, that decision must have felt, to many Americans, like the most reasonable thing in the world.